Domestic borrowing has increased by 100% thus far, indicating how high the government appetite to borrow domestically has grown, even at the expense of discounting the private sector access to much-needed capital and financing. And government is now scheduled to borrow more than 4 trillion locally next financial year, which is just days away.
So what does that mean? It means that the little money we have in the economy, in the banking institutions, we are going to be competing with the government. Last year, this ending financial year, we were competing as they were only taking 2.9 trillion. But now they have doubled the efforts. They are going to even pick more. So the implications are very dire. Number one is that this is going to increase even in the higher interest rates that we are having, because currently our interest rates are ranging from 20 to 30%. So don't be surprised that that the interest rates are now going to even increase further than that. So it becomes very expensive to borrow in Uganda.
So banks and the lenders who are in the domestic market will always run to lend to government as first priority, as opposed to the rest of, the businessmen, the enterprises, the businesses, and so it affects the economic growth.
Part of the growth in domestic debt has everything to do with government refinancing to pay back accrued debts that matures almost at the same time, which also results into another problem in the form of inflation, which is a predicament that the public sector grapples with.
But also to make the situation worse, that the central bank has also increased its CBR rate. So we are really like in a double jeopardy, that government is paying a lot of money, increasing interest rate. The central bank is in the process of controlling inflation by increasing its CBR rate.
As to whether this budget will effectively help recovery of the economy, especially on the side of the private sector, is now the question. Ismail Musa, Ladu, NTV Business.